Mike, what are we looking for?
Well, obviously, as you said, it's a very busy week. 39 S&P 500 companies reporting, big names like Johnson & Johnson, Intel, Google. But the week is sort of front-loaded and really heavy throughout the week with banks, J.P. Morgan, Wells Fargo tomorrow. Most of the analyst notes I'm reading suggest that the trading revenue lines will pretty much be flat. Equities was a little bit higher, but fixed income, other trading revenues a little lower. So probably looking at flat trading revenue. Overall, the consensus estimate is for banks to post about a 4% drop in earnings. And for example, tomorrow, J.P. Morgan, I believe their estimate is for about a high single digits drop in earnings per share. Wells Fargo about a 2%. What I find really fascinating with especially those two banks is how far off their reported number is usually compared to the estimates. Wells Fargo averages a 40% surprise, meaning its reported EPS number is on average 40% different than what analysts estimated. J.P. Morgan's is about 27%. So, it looks like, and J.P. Morgan has had, last 4 quarters, it's beaten pretty handedly, especially 3 of the last 4 double-digit percentage beats. So, you have to take these numbers, obviously, with a grain of salt.
Looking abroad to the larger banks, the story that we've seen for the last year is that simple is preferred by shareholders. As we come to domestic earnings season for those large banks, are we going to see simpler structural reforms in those banks as well?
I think one of the main themes you're going to be looking at this quarter is obviously we've had credit quality's improved. Bad loans are going down. So there are provisions for bad loans is decreasing. The debt valuations have been a big boom to banks over the last few years. A lot of analysts, Barclays for one, is questioning whether that's peaked, whether asset quality has gotten as good as it can get. And going forward with the Fed raising interest rates, it raises the question of now will we start going back the other way with have to increase provisions for bad loans and charge-offs and that sort of thing. So banks have had a really solid bank stocks have had a really solid quarter with a lot of people believing these interest rates will be good for them. But it begs the question, and I think people will be going line by line through the conference calls and the earnings reports to say, is that credit quality peaking? And that's the big question. Is this sort of improvement we've seen in credit quality, about to run out of steam?
Well, one indicator that I've been watching for the last year is the excess reserves at the Fed. This is not required reserves. This is just this is money that the banks don't have anything better to do with than to park at the Fed and get 25 basis points on it. That number has dropped in the last 3 months. Should we see this as an indication that they're finding something better to do with this money?
Yes, I think so. And another really interesting Fed data point is loan growth. I think growth was 1% quarter over quarter, not year over year. So that's a pretty, it doesn't sound like much, but that's a pretty decent number from first quarter to second quarter. So loan growth is positive for now, and that's certainly a strong signal.
In the smaller banks, and by smaller I mean $5 to $50 billion in assets. So not the tiny community banks, but the mid-sized and regional. Their asset growth has actually outstripped in the last year or so the much larger banks. Is there anything that could reverse that trend where we could watch larger banks sort of catch up in asset growth?
Yeah, I mean, obviously the big question is net interest margin and what the Fed, rate increase is going to do for that. Net interest margin for this quarter is a little bit lower than last year, but the general thinking is that it's bound to go up eventually. It comes with so many other caveats. Again, credit quality, is that going to offset that? So, it's a great question. I don't know. We'll have to see, take a look at these reports and see.
Let's look ahead over the next year. What do you see in terms of regulatory risk for the banks? What is the next shoe to drop for them out of Washington?
Well, the good news is that their expenses for lawsuits and regulatory risks have gone down significantly. And that's another sort of positive in this quarter.
Well, this is for litigation risks. You're talking about liabilities, not just the possibility of changes to laws in D.C.
Well, right. The changes to laws, I think that's anyone's guess. But it's the in the books litigation expenses have gone down significantly, and that's going to be a number a lot of people are looking at in this quarter.